In this video, I'm going to react to David Jaffee from the YouTube channel BestStockStrategy. He posted a video sharing what is the best stock market strategy in January 2021, and I thought it'd be a cool idea to react to it and basically share my opinion as we watch the video together. This is something new that I've never been doing in my channel before, some reaction videos, so I thought it'd be cool to maybe start and see if you like it. And if you end up liking it, don't hesitate to let me know in the comment section. That's really the best way to let me know if you appreciate a video or not, and I'd really appreciate it. For those who want to watch the original video, I'll put the link in the description of this video if you want to check it out. So without waiting, let's get into it.
The best stock market strategy. David Jaffee with BestStockStrategy.com, and in this video you're going to learn the absolute best stock market strategy. Remember, less is more. And some of the things that I say in this video are probably going to be very surprising to you. And I completely accept that many viewers of this video are going to reject my suggestions. But the only thing that I would ask is, if you disagree with what I say, at least keep it in consideration and keep it in the back of your mind so that in the future you will be able to execute and trade the way that I suggest. So even right now, if you don't believe that the way that I suggest is the best way for you, then please keep it in the back of your mind, because in the future, you might have a change of heart and you might change your mind.
You know, something that he says that I think is really interesting is to always keep in mind what others are saying. Regardless if you agree or disagree, especially in trading, it's very important to always hear what the opposite side is saying. Even if you don't like the fact that they're saying something negative about your strategy, it's always good to listen to the other side. So my philosophy personally is that I don't mind what anyone is saying. I don't mind about hearing the other side, what strategy is better. As long as I make the best returns possible, it's always the most important thing. Regardless if it hurts my ego or whatever, I want to have the best returns possible. So I will always listen to whatever the opposite side is saying, just so in case if I'm wrong, at least I can improve myself, I can improve my strategy, and in the end make better returns, because that's the end goal.
One of the most important things is for everyone to assume that nobody knows anything. All of the people that you watch on YouTube, all of the articles that you read, all of the people and the talking heads on CNBC, it is best to assume that they don't know anything more than you.
That's something that I really agree with. Like, it took me a long time to understand this, but when you understand that no one knows anything, literally no one knows anything about where the price is going to go, well, that changes a lot of things. Regardless if they come from a hedge fund, like, or they are on TV, or they're on YouTube, like me or anyone else, no one knows where, for example, the stock price is going to go. And that's something that is really important to understand, because I know that for a lot of people, and actually I was a lot like this, you tend to assume that the other side knows better than you. You tend to assume that hedge funds have more information about where the stock is going to go, or you think that because someone is famous on TV, they know more about you, about, for example, the stock price. Well, it's absolutely false. No one knows anything about where a stock is going to go. That's just the reality.
Because virtually all of the publicly available information is already reflected in the current market price of the specific stock. So by you actually accepting that nobody knows anything, that is going to substantially increase the amount of time that you have to dedicate towards things that are more enjoyable. So to summarize this point, do not consume any media, and also assume that nobody knows anything. This is one of the most important aspects of the best stock market trading strategy.
Yeah, something that is really like important is to not consume any media or anything that could come like bother you, basically, because what you hear most of the time is either the stock market is in a huge bull run or the stock market is in a crash, and all of this is just noise. It's literally noise. And when you're trading, you know, it's so easy to just have like so many contradictions. If I was listening to CNBC or any financial news, I would never ever trade, because you have so many contradictions, you have so many contradictory information all the time, that if you end up listening to what other people are saying, you're never going to make decisions based on your own thinking, on your own strategy. You're always going to have a reason not to place a trade.
And this might be the reason why this video could be the only stock market trading video that you ever have to watch because it will provide you with the best trading strategy. So you're not going to have to watch YouTube videos or read articles or watch CNBC. The next thing is that your differentiating factor is going to be your strategy. I do definitely believe that it's important to focus on your strategy. So irrespective of what your strategy is, I believe that instead of focusing on buying the best high-flying underlying stock, instead your differentiating factor is not going to be in your stock selection, which inherently is going to be inconsistent. Sometimes you'll have winners, sometimes you'll have losers. But the best way to earn alpha and to achieve incredible returns is going to be focusing on your strategy selection.
Yeah, I mean, that's something that I agree with that on the one hand. For example, I agree that as much as stocks, for example, liquidity is important, as much as you need to trade like healthy companies and stuff like this, the stocks that you're trading, as long as you respect like certain criteria, as I said, of liquidity and stuff like this, they don't really matter. What matters more is more like what you're doing in terms of strategy. What are you selling? Like, are you selling at the money options? Are you buying options? Are you buying in the money options? Basically, the strategy that you're using is obviously going to dictate a lot your profits. That might sound obvious, but I feel that a lot of people are focusing too much on the stock selection rather than actually what they're doing with their money in terms of selling options or buying options.
Because your strategy is going to be your differentiating factor, you want to make sure that every trade that you make has a positive expected outcome. As a result, I personally do not try to guess direction, although I would say that in my trading, I tend to be long biased because I sell put options more than I sell call options, although recently I've pretty much been selling about 60% put options and 40% call options, but I still have a long bias. However, overall, I do think it's better to not be overly directional and to not just buy Tesla shares and hope and pray that it's going to continue going up, or not buy Amazon and hope and pray that it's going to continue going up. You need some sort of hedge just in case Amazon or this overall stock market corrects by 10 or 20 or even 30%.
I would agree with this at 1,000,000%. Like, as much as you can have an opinion about where the market is going to go, you can think that the market is going to crash soon or whatever it is, you need to be able to trade both sides and not to be too heavy on either the long side or the short side. And personally, the way I trade, I have a long bias, meaning that I tend to, for example, sell more puts than what I sell calls because I just see the stock market grinding up over time. So I'm obviously going to be biased on the long side. But that doesn't mean that I'm always going to sell puts. I'm always going to try to sell some calls so as to basically hedge my portfolio. Because otherwise, if I'm too heavy on the long side and then a correction happens, then a pullback happens, then I'm going to get crushed very badly. So I always want to mitigate basically the risk that I'm taking by having a somewhat delta neutral portfolio. So it's always good to have a portfolio made up of long trade and short trades.
You want to make sure that in all market environments, you are going to beat the market. And in my opinion, the best way of doing that is to focus on your strategy selection, and that is going to be your differentiating factor. As a result, in my opinion, the best stock market trading strategy is to sell options. And the reason is that when you sell options, every single trade that you make has a positive expected outcome. And the reason is that when you sell option premium, the expected volatility is almost always more than the actual volatility. Option sellers only lose money when the actual volatility, which means when the actual move of the underlying stock is more than the expected move.
Yeah, I mean, that's true. Obviously, option sellers are going to lose when the actual move exceeds what we imply of the stock. And, there is no edge necessarily in, for example, either selling options or buying options. There are just two different ways of trading. If you buy options, you're going to have a low probability of profit, but when you write, you're going to make a lot more compared to someone who would sell options. But when you sell options, you tend to have a higher probability of profit, but a lower reward. And that's always the balance that you're playing with when you're trading options. Either you buy options, you have a low probability of profit, but you make a lot when you win, or you decide to sell options, and in that case, you have a way higher probability of profit, but you make a lot less when you win. And in a way, if you think about it, it's very logical. It would be a bit too easy if you were winning all the time and would make a ton of money every time. You obviously, both sides have their goods and bads. And personally, I'd rather lean on the option seller side because I feel it's just easier to trade when you have, let's say, 85% winners rather than having actually just 15% winners. But maybe if you prefer to buy options, maybe buying options is overall better for you. Maybe you prefer to have a low probability of profit and a big reward rather than high probability of profit and low rewards. Very often people refer to selling options as picking up pennies in front of a steamroller, meaning that you're going to make very little profit very often, but when you have a loss, it's going to offset everything. So you need to choose which side you're fine with.
When you make sure that you protect yourself from outlier moves, you can make around 30 to 40% a year with minimum portfolio volatility. Now, I know that a lot of people have a YOLO type mindset where they're going to try to turn like $200 or $2,000 into $1 million. But the likelihood of you actually accomplishing this is very low. Additionally, the pain that you're going to experience from losing money and the stress that you're going to endure from the highs of making money to the lows of losing money are simply not worth it.
I mean, this I would tend to disagree. For example, if someone is willing to actually buy options, have a low probability of profit, but it's like buying a lottery ticket. You know that you might not win often, but when you win, it's going to be big. If someone is willing to do this and they want to invest like this, I'd say fair enough. However, from experience and personally, I've never met anyone that was actually making money consistently, meaning that year after year by buying options. After that, like you might know some people that make a ton of money buying options consistently. But that's the key word. That's always about the consistency part. If you can make this over and over and you can still generate some alpha by buying options, then I'd say fair enough.
And the more experience that you gain, the more you're going to realize that minimizing your overall portfolio volatility is a major contributing factor to the success of the strategy that you choose. Additionally, if you're able to
All right, okay, I see. That's cool. Sorry about that small technical issue. Let's get right back in.
minimize the portfolio volatility, then you're going to have significantly more longevity to be able to compound the gains so that your account size drastically increases in size. I like to sell option premium, and specifically, I'm going to get a little bit more technical here. Now, the VIX, which is a measure of market volatility, is trading over 20. I sell naked options. When the VIX is trading under 20, then I will sell vertical credit spreads, which means that I will buy a put or a call option to hedge my short put or call options. This protects me against outlier moves and it protects me against black swan events.
Yeah, I mean, I do exactly the same. I tend to sell credit spreads when the VIX is low and actually sell naked options when the VIX gets higher so I can benefit from bigger premiums. And the thing is, when you sell credit spreads when the VIX is low, you're doing this because usually when there is a crash that happens, it doesn't necessarily send a warning or anything. It happens, and usually the actual move is so brutal that if you were selling naked options, you would lose a ton of money in the span of very few days. So by selling credit spreads, you obviously maybe limit your profit that you're making, but you are absolutely going to mitigate the loss that you're going to have if you were just going to sell naked options. And the thing is, even if a big crash happens and you were selling a credit spreads, nothing prevents you from rolling your short options to a later expiration and just either leaving the long option or just taking your profit on your long option. And that's it, and you just transform and you just turn your credit spreads into a naked options. And at least you have mitigated a lot of loss by having that long leg that will have increased a lot in value and so make you a lot of profit.
Building off some of the first recommendations that I made in this video, I only sell option premium on market-leading large cap underlyings like Amazon or Tesla or Microsoft or JP Morgan or Visa or MasterCard or Disney or McDonald's. I ignore everything else. In fact, on my watch list, I only have 13 securities. Occasionally, I will sell call options on underlyings that are not on my watch list that I believe represent good trading opportunities because they might be overbought. But in general, my core positions are only going to be established on the 13 stocks that are on my watch list.
I understand why he does this. I understand why he wants to focus on market leaders, because obviously you're going to have more healthy companies and all of the information is going to be already priced in. I get why he's doing this, but the problem with that is that it's really not accessible unless you have a huge account. Like to just sell, a naked put, for example, an Nvidia or Visa or MasterCard, you need to have a ton of buying power available. And I think that David Jaffee has a way bigger account than what I have, and personally, I couldn't afford to trade the stocks that he's trading. So I have to go for cheaper stocks where there is a cheaper buying power requirement so I can actually trade and not take too much risk. But if you have the capital to do so, if you have the capital to trade market leaders, I think that's definitely a go.
And I think I rattled off about 8 or 9 of them just 30 to 45 seconds ago. If you are not interested in selling option premium, which many people who sell option premium end up winning over 95% of their trades. Now, your win rate at over 95% is incredible. Try accomplishing that same win rate when you trade other strategies. The reason why we can accomplish such a high win rate is because the expected outcome of every single trade that we make when we sell option premium is positive.
Obviously, there is no free lunch. If you decide to sell a very far out the money option, you're not going to make a ton of money, but you're going to win very often. But the problem is when there is actually a crash or something that happens, is the loss going to offset all the wins that you made before? But inherently, there is no edge to whatever you're doing if you're buying or selling options. You're always playing with good sides and bad sides. And, it depends on, as I said before, which side are you comfortable trading with. And personally, as I said, I'd rather sell options than buying options.
However, if you're not ready to sell option premium, then the best strategy that's going to provide you with the best bang for your buck is to simply buy the S&P 500 or buy a large cap stock that you believe in, like Amazon or Tesla or Facebook, and then sell short-dated 2 to 3 week out expiration covered calls against that position.
That's fair. That's a fair strategy to use. Like, that's obviously going to be in a way safer than just trying to sell naked calls and naked puts. However, by selling covered calls, we imply that we're going to have to buy 100 shares of the stock. And by doing so, you need to have a ton of capital by just the nature and the price of the stocks. For example, Amazon right now is around $3,000. So if you were willing to buy 100 shares of that stock, it would be 300 grand of buying power. So you know that, if you want to trade covered calls on this type of market leaders, it's going to take a lot of buying power anyway. So you might as well, just sell naked calls and naked puts on random stocks. So that can be a problem because obviously covered calls, you need to buy the 100 shares of the stock, which can mean quite a lot of capital for a lot of people.
By selling the covered call against that position, you'll be able to generate an incremental 8 to 12% a year, depending upon the strikes that you select. And when you factor in the overall historical price appreciation of the S&P 500 or Amazon or Tesla or Facebook, you should be able to generate around 15 to 20% a year when you also factor in the increased income that you're going to generate from selling the covered calls.
It's true that by just selling covered calls, by just selling calls against, for example, shares of a stock that you own, or for example, the SPY, if you decide to, for example, buy the SPY and just follow the index, it's true that honestly, when you do it, you can actually manage to generate some income, or I'd say not necessarily some income, but you can generate some nice returns by just selling calls against shares of stocks that you own. And it's actually quite crazy that no one else is doing it. But obviously, the problem with covered calls is that if the stock goes up and you have sold some some naked calls, and then, you know, your naked calls is in the money, then you have to roll it up to a higher strike. Otherwise, if you get a sign, you just have to sell the 100 shares that you own, which is not necessarily the ideal case for everyone. That was the end of this reaction video. Let me know if you liked it, and let me know what you thought about this video overall in the comment section. I'm really intrigued to know what are your feedbacks, and if you'd like to see more videos like this one. Please make good and informed decisions. I'll see you in the next video, and in the meantime, I wish you all the best.